There's a number living rent-free in your head right now. You might not say it out loud, but it's there. 1 million. Maybe 2. Some retirement article planted it years ago, and you've been measuring yourself against it ever since. That number is almost certainly wrong. Not because you're bad at math, but because the formula behind it is missing half the equation. It doesn't account for your social security. It skips over any pension, rental income, or side income you'll have. It assumes you'll spend exactly the same amount at 80 as you do at 62. And it's built to survive the single worst market in a century, not the most likely one. Once you plug those missing pieces back in, the actual number you need could be hundreds of thousands of dollars less, and the math takes about 5 minutes. Let's do it. The formula you've probably seen is called the 25x rule. Multiply your annual spending by 25, and that's supposedly your retirement number. Spend $50,000 a year, save $1.25 million. Spend $70,000, save $1.75 million. It comes from William Bengen's 4% rule research in 1994. He backtested every 30-year period in US market history and found the worst-case safe withdrawal rate was about 4%. The 25x multiplier is just the inverse of that, and it's useful as a rough starting point. But the problem is that it was designed to survive the absolute worst-case scenario on record. In 96% of all historical periods, a retiree following this rule would have ended up with more money than they started with, sometimes double. That's like buying a winter coat rated for negative 40 degrees because you live in Atlanta. Could it get that cold? Technically. Has it ever? No. And meanwhile you're sweating through October in a parka you didn't need. You could have bought a normal coat and used the difference for something that actually improved your life. The 25x rule isn't a target. It's an extreme safety margin. And when people treat it like a minimum requirement, they end up working 5, 10, maybe 15 extra years, chasing a number that was never meant to be realistic. What comes next is the formula that replaces it. And it changes the math completely. Financial planners don't use the 25x rule with their actual clients. They use this. Annual expenses minus guaranteed income, divided by withdrawal rate. That's your required portfolio. The 25x rule is just a lazy version of this. It assumes zero guaranteed income and a flat 4% withdrawal rate. When you fill in the real numbers, the picture looks completely different. Let's start with what you'll actually spend. The typical retiree household spends around $50,000 a year, roughly $4,200 a month. Not $80,000 or $100,000 like the headlines suggest, but closer to $50,000. That's based on Bureau of Labor Statistics data adjusted for the fact that averages get inflated by wealthy outliers. If your current spending is higher than that, use your own number. But you'd be surprised at how much less you spend once the commute, the work clothes, the payroll taxes, and the retirement contributions disappear. Now subtract your guaranteed income. This is where the math gets interesting, because you probably have more of this than you think. Social Security is the biggest piece. The average retired worker collects about $2,076 a month, roughly $24,900 a year. A couple with 2 earners brings in around $3,200 a month combined. But that's just the starting point. A pension counts. Net rental income counts. If you plan to do consulting work or part-time teaching for the first few years, that income counts too. Every dollar of guaranteed income is a dollar your portfolio doesn't have to produce. Let's do the math for a single person. Spending $50,000, collecting $24,900 from Social Security. The gap is $25,100. Divide by a 4% withdrawal rate, and you need $627,500. Divide by 4.7%, which is what Bengen's own updated research now supports, and you need $534,042. The 25x rule says you need $1.25 million. The complete formula says you need roughly half of that. The difference is $600,000 to $700,000 that you don't need to save. That's years of your working life you could get back. For a couple it shifts even more. BLS data for the 65 to 74 age group shows average household spending around $65,000 a year. 2 Social Security checks at $38,400 combined, plus $10,000 a year in net rental income. That's $48,400 in guaranteed income. The gap is $16,600. At 4%, they need $415,000. The 25x rule applied to $65,000 says $1.625 million. That's a difference of over $1.2 million. And it changes the entire conversation from can we ever retire to when do we want to? Here's something the standard advice gets wrong that almost nobody talks about. The 25x rule assumes you spend the same amount every year for 3 decades. In real life, that basically never happens. Retirement spending follows a pattern researchers call the spending smile. Phase 1. The go-go years, roughly 62 to 72. This is when spending is highest. You travel, you renovate, you say yes to things you put off for decades. Then comes Phase 2, the slow-go years in the mid-70s to early 80s. Spending drops, transportation costs fall, dining out slows down, you're not replacing your wardrobe for the office anymore. You're also no longer paying payroll taxes or making retirement contributions, which alone frees up 15 to 20% of what you used to earn. BLS data shows households over 75 spend about 22% less than the national average. Phase 3 is the no-go years, late 80s and beyond. Most spending categories drop further. The exception is healthcare, which can spike, but the overall trajectory is down, not up. This means you can plan in phases instead of one giant number, and when you do that, the total drops again. Say you retire at 62, Social Security doesn't start until 67. Phase 1 is a bridge. You spend $55,000 a year for 5 years with no guaranteed income. So you set aside $275,000 in cash and short-term bonds. That's not a withdrawal rate calculation. It's just $55,000 times 5. Phase 2 starts at 67. Spending drops to $42,000. Social Security kicks in at $24,900. The gap is $17,100. Divide by 4%, and the portfolio you need is $427,500. And by your 80s, spending drops even further, which means you're pulling less from the portfolio each year and it stretches longer. That's the spending smile working in your favour. Add the bridge fund and the investment portfolio together. $275,000 plus $427,500 equals $702,500. Compare that to $1.375 million, which is what 25 times your peak spending would demand. The phase approach cuts the number nearly in half. If you're the kind of person who actually runs the numbers instead of guessing, do me a favour and hit like and subscribe. It helps more people find videos like this one, and we've got a lot more to cover. Everything I've shown you so far paints a better picture than the standard advice. But this only works if you plan for the risks that can blow it up. First, Social Security isn't guaranteed at current levels. The trust fund's projected to be depleted by 2033. If nothing changes, benefits drop to about 77% of what's promised. That's straight from the Social Security Administration's Trustees Report. Run the formula at both full benefits and 77% to see what each scenario requires. For our single person spending $50,000, that stress test pushes the required savings from $627,500 to roughly $770,000. Still well below $1.25 million, but it's a real gap you should plan for. Second, healthcare. Fidelity's latest estimate puts lifetime healthcare costs for a couple retiring at 65 at $345,000. And that's after Medicare. Long-term care runs a median of $115,000 per year for a nursing home. And roughly 70% of Americans turning 65 will need some form of it. Add a healthcare buffer of $100,000 to $175,000 per person on top of your formula number. Third, taxes take a cut of every withdrawal from traditional retirement accounts. A $40,000 pull from a 401k might only put $33,000 in your pocket. Spreading your savings across pre-tax, Roth, and taxable accounts gives you more control over what you owe. Fourth, inflation. At 3% annually, purchasing power drops nearly 60% over 30 years. Healthcare compounds even faster at 5 to 6%. The 4% rule builds in an annual inflation adjustment, but that only works if your portfolio keeps pace. Going all in on bonds at 65 might feel safe, but it creates a different kind of risk entirely. The formula gives you a number. These 4 factors tell you how much cushion to wrap around it. So here's where you are. You came into this video with a number in your head that felt unreachable, and the standard advice was happy to confirm that you should be worried. But the complete formula tells a different story. When you subtract real income, use an evidence-based withdrawal rate, and plan for how spending actually shifts over time, the number you need drops significantly. For some of you, it could mean retiring years earlier than you assumed. 3 steps before you click away. First, figure out what you actually spend each month. Pull your last 3 months of bank and credit card statements, average them, and multiply by 12. That's your annual spending. And keep in mind, this is probably the high end. Once you're retired, work-related costs, payroll taxes, and retirement contributions all disappear, so your actual number in retirement will likely be lower. Second, check your projected Social Security benefit at ssa.gov and total up any other reliable income, pensions, rentals, anything. Third, run the formula at a few different withdrawal rates and see the range. Once you've done that, drop your results in the comments. Was it higher or lower than the number you had in your head? I'm genuinely curious because almost everyone who runs this is surprised. And if this shifted how you think about retirement, hit like, subscribe, and share it with someone who needs to see it.